G'day guys, Ben.eick here from Nectar Home Loans Hunter. Today we're going to have a chat about guarantor loans and try and tell you all about them and make you feel comfortable as a borrower and as potentially mum and dad offering their property as a guarantor property to help kids get in the market. So what is a guarantor loan? Basically it's mum and dad or a family member helping their children or grandchildren perhaps getting into the market. It's really hard to save up for a deposit these days with the house prices taking off and kids need $50,000, $60,000, $70,000 and it's no easy task to save up that amount of money. So if parents do have equity in their home, they can use that equity for a period of time to enable the kids to get into a home without having to save for a deposit and without having to pay mortgage insurance. They're two really cool things, and it doesn't really cost mum and dad a cent at all. The period of the guarantor loan could potentially be anywhere from 18 months to maybe 3 or 4 years at the most. And in my nearly 20 years of mortgage broking, we've never had one fall over yet. There's never been a bad experience, so fingers crossed it's going to be the way forward. So what I want to do with you now is show you the nuts and bolts, the mathematics behind it, so you can get really comfortable with exactly how it works. So there are a number of lenders that are offering guarantor loans. Some of them require the parents to be working, some of them require the parents' properties have no debt. Others say if parents retired, it's a no-go. So there are a number of different factors to look at, and that's why you need to come to a mortgage broker to find out which banks are going to suit potentially the parents more, because some banks, if the parents aren't working, the bank won't let them be guarantors, but other banks will. That's why you need to come and see me. So let's just say back in the 1980s when you can buy a house for $500,000, let's say we're buying a house for $500,000 here. So this is the kids' home for $500,000. What we do with the loan is we actually split it into two portions. So we have portion one, which is $400,000, which is 80% of the $500,000, is loan number one. Then loan number two is over here. So this is mum and dad's home. They already owe $250 on their home. It's worth $800. So we need 20%, which is 100K, so 100 plus 400 make up the 500 purchase price. If they're not first home buyers, they're also going to need stamp duty. Or if they're buying a house worth over 800,000, they're going to have to pay full freight on stamp duty, even if they are first home buyers. So just a side note, anything once you hit 650 to 800, you start paying stamp duty. It's a little bit at 650 to 7, it just creeps up. By the time you get to 800, you're paying full freight. But with the guarantor loan, we can actually borrow the stamp duty as well, which is super cool. So in this example, we've got the 100,000. We're pretending the kids aren't first home buyers, and they need an extra 18 for the stamp duty, and they need 2 for legal. So this comes to $120,000. So basically, the parents have got already $250 there. We can then add on the $120K loan onto the parents' property. Now the parents aren't responsible for paying this loan or this loan. It's up to the kids to pay both the $400 and the $120, which is $520 in total. So this is how much the loan will be, $520,000. Now, a thing we have to check out is to make sure the mum and dad have enough equity in the property. So in this example, the parents already owe $250 on their home. They're going to absorb another $120, so that's coming to $370,000. Now, the existing loan, the $250, plus the new loan, the $120, can't go over more than 80% of the value of the property. So this figure here can't be more than 80% of that. Obviously it's not. 600 is 80% of 800, so 370, there's plenty of room. But if the parents were highly geared here and they already owed, say, 600 on their $800,000 home, there's not that room in there to do it, because if we add on the 120 loan, it's going to be 720. 720 is more than 80% of 800, so that would be a no-go. But in this situation, plenty of room, and most of the time, especially in the way the market's been going, everyone's got another $150,000, $200,000 in their property over the last 18 months, so there's plenty of room for parents to give the kids a go. So anyway, we get the loan approved, kids move in, they're paying down the loan, things are going great. Their house is going up in value, next thing you know it's worth $600,000. That might take 6 months, it might take 2 or 3 years, we don't know. Just depends on what the market does. The kids are also paying down their $400,000 loan, and the kids are also paying down this $120,000 loan. So both these loans are actually going down in value. So let's say in 2 years' time, this loan's only about $380, and this loan, say, $100, that only equals $480. The house has gone up in value to $600. So what we can then do is we can move this now $100,000 loan over back onto the kid's property and give the title deeds back to either the lender or mum and dad get their deeds back if they didn't owe any money, because the kids can actually then move that $480,000 loan onto their own home, because it's now worth $600,000 and that's 80% of that. So this is a really cool way to do to get the kids into the market, not paying any extra money, not paying mortgage insurance. It doesn't cost mum and dad anything. All they just have to be a little bit nervous Nelly for a couple of years while the kids are paying off their loan. But as I've said, in 20 years, I've never seen it go pear-shaped yet. So, and I don't think it will either. So yeah, any more questions you have around guarantor loans, please just comment or give us a call or shoot us an email. We're only too happy to walk you through them. This is basically how they work. Thanks. Ben.eick from Ben.eick Homelands Hunter.